Let's do a walkthrough using a basic example. Say we're only interested in the top 5 largest NASDAQ stocks, and we want to rank them in order of their desirability as an investment. For this exercise, we'll only consider value and momentum, since sourcing the data that goes into these two factors will be fairly straightforward to demonstrate. In reality, you'll probably want more factors in your model to provide diversification, just like how you diversify with stocks. First, let's define what we actually mean by each factor. For value, I used a metric called forward price to earnings. It tells us how many dollars investors are willing to pay today for each expected dollar of earnings over the next year. I pulled this number for each of the 5 stocks from Yahoo Finance. For momentum, I used the most common definition, which is the stock's total return over the past 12 months. In practice, you'd typically exclude the most recent month's return, since research shows there's often a short-term reversal effect at that 1-month mark. But to keep things simple, we won't get into that level of detail here. So now we've got our raw numbers for value and momentum. Next, we need to scale these raw numbers so they contribute equally to the scoring system. Right now, value and momentum aren't even measured in the same units, so we can't compare them directly. One simple way to fix that is by ranking each stock from 1 to 5 on each factor. For value, a rank of 5 means the most attractive or the best value. We'll do the same for momentum. 5 means the strongest performance. Once we've ranked the factors, we simply average the value and momentum scores to get what's called an alpha score. This gives us a rough estimate of which stocks have the strongest upside potential based on their underlying characteristics and using a simple systematic model. There are more advanced ways to combine factors, but here we're using the basic approach of equal weighting. For a detailed breakdown, watch the full video on my channel.